A stock does not drop 28% in one day because of bad luck. Supermicrocomputer lost more than a quarter of its market value today, in a session where the broader S&P 500 was down just 1.6%. That is not a market story. That is a company story layered on top of a market story. And the combination is what creates the kind of move that either destroys portfolios or creates generational entry points. The question you need answered right now: which one is this? A rational repricing of a structurally broken business, or an emotional overreaction to a fixable problem? Let's start with the facts as they exist on June 10, 2026, because precision matters here. The S&P 500 was already under pressure, down 1.6% on the session, VIX at 22, which signals elevated but not extreme fear. That macro context matters because it removes liquidity from the market and amplifies moves in high beta names. SMCI, with a historical beta north of 2.0, was always going to get hit harder than the index on a red day. But a 2x beta explains maybe a 3 to 4% decline. It does not explain 28. What explains 28 is the company-specific layer on top. Supermicro sits at a critical but precarious position in the AI infrastructure stack. They design and assemble server systems, the physical racks that house NVIDIA GPUs and run the data center workloads that every hyperscaler and enterprise AI deployment depends on. When AI CapEx was expanding at double-digit quarterly rates, SMCI was printing revenue growth that made it look like a compounding machine. The problem with being a hardware assembler in a boom cycle is that you are also a hardware assembler in a bust cycle. The catalyst today appears tied to a combination of factors that the market decided to price simultaneously. Margin compression signals from a major customer renegotiating volume pricing, renewed scrutiny of SMCI's inventory position as lead times on AI server components have shortened, and a broader repricing of AI infrastructure names as investors debate whether 2026 data center CapEx commitments from the hyperscalers are being executed on schedule or quietly deferred. None of these individually breaks the thesis. Together, in a risk-off tape, they became a 28% event. The actionable insight here: when you own a name with 2x plus beta in a sector defined by lumpy demand cycles, position sizing is not optional. It is the primary risk management tool. This is the harder question, and it is the one that actually determines whether today's price action creates an opportunity or a warning. Let's think about this rigorously. A 28% single-day decline implies the market is either re-rating the company's forward earnings power by roughly that magnitude, pricing an existential risk to the business model, or simply liquidating in a momentum, unwind with limited regard for fundamental value. These are very different situations. The first is rational. The second requires evidence. The third is temporary by definition. Here's what we know about SMCI's fundamental position. They are not a fabless semiconductor company with pricing power. They are an integrator. That means their moat is operational. Speed to deploy, customization capability, and relationships with hyperscale buyers. Those advantages are real, but they are not durable in the way that intellectual property is durable. A competitor with sufficient manufacturing scale can erode that position given enough time and capital. What we also know is that SMCI has been here before. The stock has experienced multiple drawdowns exceeding 30% since its emergence as an AI infrastructure play. In late 2023, in mid-2024, and again in early 2025. Each time recovering as the underlying demand for their products reasserted itself. Past recovery is not a guarantee of future recovery, and anyone who tells you otherwise is selling you something. But it does establish a pattern. The market repeatedly overreacts to SMCI's near-term volatility because the stock attracts momentum-driven capital that exits faster than it enters. The honest assessment: today's move looks like a combination of rational margin concern, maybe worth 10 to 12% on its own, amplified by forced selling and momentum liquidation that accounts for the other 16 to 18 points. That gap between the fundamental reality and the market price is where edge lives. But only if the fundamental concern is genuinely contained and not the beginning of a structural deterioration. You have to do that work yourself. This is not financial advice. There is a mistake that a large cohort of investors made starting in 2023, and SMCI was one of the clearest examples of it. The mistake is conflating proximity to a secular trend with participation in its economics. NVIDIA owns the AI compute stack at the chip level. That is genuine pricing power, gross margins above 70% that reflect the fact that no meaningful substitute exists for their training silicon right now. Supermicrocomputer is essential to the deployment of that compute, but essential is not the same as irreplaceable. They sell systems where competition is fierce, where customers have leverage on pricing, and where a single quarter of gross margin degradation, going from 14% to 11%, for example, can compress a valuation model significantly when the market is already nervous. This is the infrastructure hardware trap. When the sector is hot, every name in the supply chain gets re-rated as if it has the economics of the dominant platform. When sentiment turns, the market differentiates aggressively, and the integrators and assemblers get sold first because their earnings are most exposed to volume and pricing cycles. The lesson for your portfolio construction is specific. If you want AI infrastructure exposure, you need to be precise about where in the value chain your companies operate and what protects their margin. A data center REIT has contractual revenue. A hyperscaler has diversified revenue streams. A GPU designer has intellectual property. An assembler has relationships and execution, valuable but fragile, under pressure. Watching SMCI fall 28% today while the index fell 1.6% is not a commentary on AI as a theme. AI infrastructure spending is not disappearing. It is a commentary on what happens when you own the wrong part of the value chain, at the wrong valuation, at the wrong moment, in the sentiment cycle. Understanding that distinction is the difference between learning from someone else's expensive day and eventually having your own. We opened by asking whether today's 28% drop was a rational repricing or an emotional overshoot. The honest answer? It is probably both. A legitimate fundamental concern that got amplified by a high beta structure and a risk-off tape into something much larger than the underlying news warranted. The more important question going forward is what this tells you about how to size and position